Hello and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. Joining me today is Eric Clapsaddle, our Senior Fixed Income Portfolio Manager. Eric, there's really no lack of news when it comes to the economy. We have earnings season, we have inflation rising, we have Federal Reserve news, we have pending elections, we have higher interest rates. Right. Just a lot of things going on for investors today. And so we're going to kind of narrow it down to just really two topics. We're going to talk about higher interest rates that we're seeing, and then also the economy and how higher interest rates might impact the economy. So let's start with higher interest rates. Clearly much higher than they were a year ago. Very painful for clients, but it should be better going forward. So, kind of where are rates today and what are we seeing?
Sure. Well, rates are higher. They're a lot higher. And since mid-2021, they've made a historical upward move. As you can see in the chart, the 2-year Treasury note was yielding only 0.14% on June 10th, 2021, and today is around 4.6%. Over the same time frame, the yield on the 10-year Treasury has increased by approximately 3 times and is sitting around 4.2%. It has most definitely taken some pain to get there, but this short-term pain is going to result in long-term gain for fixed income investors. In mid-2021, we were building fixed income portfolios that yielded around 2%. Today, we're building them and they yield around 5%. This is allowing us to take away some equity exposure for clients and maintain the same levels of return, reduce risk, or it's just allowing balanced portfolios without any adjustments to earn more. Outside the United States, it's been pure pain for the bond markets. As you can see in the chart, total bonds with negative yields have dropped from $18.4 trillion to around $1.5 trillion. The global bond market, excluding the United States, is down about 24% year to date, or for the first 9 months of the year. To be clear, we have had and will continue to have a zero allocation to global bonds. Over the next 12 months, and beyond, I say beyond the next 12 months, we expect rates to plateau about where they're at today. And even as inflation subsides, the Federal Reserve is additionally going to step away from their easy monetary policy, which should keep rates close to where they're at today and continue to make fixed income an attractive asset class.
These are some of the best yields we've seen in 15 years, really pre-Great Recession. Yep. And so for investors going forward, it's going to be a very nice addition to their returns in their portfolios. Now, while that's great for investors, higher interest rates can have other impacts, and now it's always so positive. So let's talk a little bit about the higher interest rates and how that it might impact the economy or certain sectors of the economy.
Sure. So we have seen almost everything slow down. And it's more than simply the Federal Reserve being more restrictive with monetary policy. It's the disappearance of substantial fiscal stimulus in 2020 and 2021, which grew the economy and ultimately inflated the economy. Economic growth in the first 2 quarters of this year were both negative. First quarter was down 1.6%, and then the second quarter was down 0.6%. On a positive note, though, expectations are for the last 2 quarters of the year to be positive. But when you think 12 months together going forward, we expect total GDP to hover around 0%. In regards to housing, we've started to see signs of slowdown there. The S&P CoreLogic Home Price Index declined for the first time since March 2012 in July. And we've seen some softening in the labor markets, with job openings becoming a smaller number, job cuts increasing, and continuing jobless claims slowly rising. Ironically enough, this is what the Federal Reserve wants: to create price stability, which in their term is inflation. They want to see a slower economy, which means reduced demand and ultimately less inflation, more price stability. And whether to them price stability inflation is at 2% or somewhere around there, what the economy really needs is inflation to be at a level that does not affect their regular purchasing habits.
That's a very great point. The Fed wants inflation not to be part of the equation for the consumer. The other interesting thing about the Federal Reserve raising rates is that they tend to have a 6 to 9 month lag in the economy. So those early increases that we started to see in February and March are only starting to hit the economy now. The most recent and more dramatic increases, we might not see that for another 3 to 6 months. So it'll be really interesting to watch the economy and how well the consumers and corporations adjust in the months ahead. As always, we're working really hard to make sure that we manage your portfolios in the best way possible. And as always, thank you for the opportunity to serve you and your family, and have a great day.